Public Sector Accounting and Finance. Table of Content. Introduction. Chapter 1. Introduction to Public Sector Accounting. Chapter 2. Theoretical Frameworks and Standards in Public Sector Accounting. Chapter 3. Public Sector Accounting Systems. Chapter 4. Budgeting in the Public Sector. Chapter 5. Public Expenditure Management. Chapter 6. Revenue Generation in the Public Sector. Chapter 7. Public Debt Management. Chapter 8. Auditing in the Public Sector. Chapter 9. Financial Reporting and Accountability. Chapter 10. Public Sector Financial Management Reforms. Chapter 11. Ethics and Governance in Public Sector Accounting. Chapter 12. Emerging Trends and Innovations in Public Sector Accounting and Finance. Epilogue. Introduction. Public sector accounting and finance are the pillars on which governments plan, execute, and evaluate their policies and programs. Unlike private enterprises, which focus primarily on profit, public sector organizations are entrusted with managing resources on behalf of citizens, delivering essential services, and promoting social and economic development. This unique responsibility demands not only technical expertise in accounting and financial management, but also a commitment to transparency, accountability, and ethical stewardship. In today's dynamic world, the expectations placed on public finance professionals have never been higher. Governments face mounting pressures, from fiscal deficits and public debt to demands for efficient service delivery and sustainable development. Citizens expect clarity and accountability in how their taxes and public funds are utilized, while international organizations and investors demand robust financial reporting, governance, and risk management. In this environment, public sector accounting is more than a function. It is a strategic tool for good governance, social equity, and economic stability. This book seeks to provide a comprehensive, practical, and forward-looking guide to public sector accounting and finance. It is designed for students, practitioners, policymakers, and auditors who wish to understand not only the technical aspects of budgeting, accounting, and auditing, but also the broader principles of governance, ethics, and innovation that define modern public financial management. The chapters are structured to build a holistic understanding of the field, from foundational concepts of public finance, revenue generation and expenditure management, through debt management, auditing, and financial reporting, to contemporary trends such as integrated financial management systems, performance-based budgeting, sustainability, and digital innovation. Along the way, the book emphasizes real-world applications, case studies, and practical exercises to bridge theory with practice. As you read this book, you will discover that public sector accounting is not merely about numbers, it is about trust, responsibility, and the effective stewardship of public resources. The insights offered here aim to equip you with the knowledge, skills, and ethical grounding to navigate the complexities of public finance, make informed decisions, and contribute meaningfully to the development and governance of your nation. In essence, this book is a guide for those who aspire to turn public resources into public good, ensuring that every dollar spent advances the mission of government, the welfare of citizens, and the long-term sustainability of society. Welcome to the world of public sector accounting and finance, a world where accuracy, accountability, and integrity are not just ideals but imperatives. Chapter 1. Introduction to Public Sector Accounting. 1.1 Overview. Public sector accounting is the process of recording, analyzing, summarizing, and reporting financial information for entities operated by the government or public authorities. Unlike private sector accounting, which focuses on profit maximization, public sector accounting emphasizes accountability, transparency, and stewardship of public resources. Public sector entities include central and local governments, government agencies and ministries, state-owned enterprises, public institutions such as universities and hospitals. Key objectives: ensure accountability of public resources, Provide information for policy making and public decision making. Promote transparency and public trust. Monitor compliance with laws, regulations, and budgets. 1.2 Differences between public and private sector accounting. Example: a city council collects taxes and allocates funds to education, healthcare, and infrastructure. Their focus is not profit, but effective service delivery. A private school uses tuition fees to maximize returns for its owners. 1.3 Key concepts in public sector accounting. Accountability. Public officials must answer for the use of public resources. Transparency. Financial operations must be open to public scrutiny. Stewardship. Government manages resources responsibly for citizens' benefit. Budgetary control. Monitoring actual spending against approved budgets. Fund accounting. Segregation of resources into funds to track their intended use. 1.4 Importance of public sector accounting. Helps governments manage scarce resources efficiently. Provides a basis for evaluating program effectiveness. Facilitates fiscal policy formulation and planning. Enhances citizens' confidence in government operations. Case study example: in country X, weak public accounting practices led to misallocation of infrastructure funds. By introducing fund accounting and regular reporting, transparency improved, and citizens could track how tax money was spent. 1.5 Components of public sector accounting. Budgetary accounting, tracking appropriations, allocations, and expenditures. Financial accounting, recording financial transactions and producing reports. Management accounting, internal reporting for decision-making and performance evaluation. Cost accounting, analyzing the costs of public programs and services. Audit and assurance, ensuring compliance with laws and proper use of funds. 1.6 Users of public sector accounting information. Internal users, ministers, department heads, and program managers. External users, Parliament oversight bodies, citizens, donors, and investors in public projects. Example table. 1.7 Accounting standards for the public sector. IPSAS, International Public Sector Accounting Standards, Framework for Accrual-Based Accounting. GFS, Government Finance Statistics, Standards for Fiscal Reporting. National standards. Many countries have their own regulations, e.g. GASB in the USA. 1.8 Challenges in public sector accounting. Complexity due to multiple funding sources. Political interference affecting reporting accuracy. Limited adoption of modern accounting technology. Weak capacity and skills in some government agencies. Example: a municipality may receive funds from federal grants, local taxes, and international donors. Each source may have different reporting requirements, making consolidated reporting challenging. 1.9 Summary. Public sector accounting differs fundamentally from private sector accounting. It focuses on accountability, transparency, and service delivery rather than profit. Understanding its key concepts, components, and challenges is critical for anyone involved in public finance. 1.10 Exercises. Explain the main differences between public and private sector accounting. Describe the importance of accountability in public sector finance. Give examples of public sector entities in your country. Research the public sector accounting standards applicable in your country. Discuss the challenges that may hinder proper public sector accounting. Chapter 2. Theoretical Frameworks and Standards in Public Sector Accounting. 2.1 Overview. Public sector accounting is not just about recording transactions. It is grounded in theories, principles, and standards that guide financial reporting, budgeting, and accountability. Understanding these frameworks is crucial for ensuring consistent, transparent, and reliable financial information in the public sector. This chapter covers the theoretical foundations of public sector accounting, key principles guiding financial reporting and budgeting, International and national accounting standards. Conceptual frameworks supporting accountability and performance. 2.2 Theoretical foundations of public sector accounting. Stewardship theory. Stewardship theory emphasizes that public officials are trustees of public resources, not owners. They are expected to act in the best interest of citizens and ensure resources are used effectively. Key points. Officials have a fiduciary duty. Financial reporting should demonstrate proper use of resources. Budget compliance and performance evaluation are central. Example: a city treasurer allocating tax revenue to schools and hospitals must ensure funds are spent as intended, reporting any deviations transparently. Public choice theory. Public choice theory applies economic principles to public sector decision-making. It suggests that individuals in the public sector respond to incentives. Decisions may reflect self-interest as well as public interest. Implications for accounting. Transparent reporting and audit mechanisms are needed to minimize misuse. Budgetary controls act as incentives for efficient resource utilization. Accountability theory. Accountability theory underlines that public officials must justify their actions and financial decisions to stakeholders. Financial statements, performance reports, and audits are tools of accountability. Emphasizes answerability, enforcement, and transparency. Diagram example: accountability cycle. Planning and budgeting, right pointing arrow 2. Execution, right pointing arrow 3. Reporting, right pointing arrow 4. Audit and evaluation, right pointing arrow 5. Feedback and adjustment. Performance measurement theory. Performance measurement theory focuses on assessing efficiency, effectiveness, and economy in public service delivery. Efficiency, optimal use of resources. Effectiveness, achievement of intended outcomes. Economy, cost minimization without compromising quality. Example: a public hospital may track the cost per patient treated and patient satisfaction to evaluate performance. 2.3 Key principles of public sector accounting. Relevance. Financial information should be useful for decision-making by managers and stakeholders. Reliability. Information must be accurate, complete, and free from bias. Comparability. Financial reports should allow comparisons over time and across organizations. Understandability. Reports should be clear and comprehensible, even to non-accountants. Accountability. Financial reporting should demonstrate proper use of resources and adherence to legal requirements. Example table: principles and practice. 2.4 Public sector accounting standards. International standards. IPSAS, International Public Sector Accounting Standards. Developed by the International Public Sector Accounting Standards Board, IPSASB. Provides guidance on accrual-based accounting for governments and public sector entities. Focuses on transparency, comparability, and accountability. Examples of IPSAS standards. IPSAS 1. Presentation of financial statements. IPSAS 24. Presentation of budget information. IPSAS 33. First-time adoption of accrual basis. National standards. Many countries adopt national standards, often aligned with IPSAS. GASB, Government Accounting Standards Board in the USA. FRSSE, Financial Reporting Standards for Smaller Entities in the UK. National variations address local legal, fiscal, and cultural contexts. Example: a government may require fund accounting for social welfare programs to ensure legal compliance and proper allocation. Cash versus accrual accounting. Cash basis, transactions recorded when cash changes hands. Simpler, but less informative. Accrual basis, transactions recorded when incurred, providing a more complete picture of financial position. Example table, comparison. 2.5 Conceptual frameworks for reporting. Objectives: ensure decision-useful information and accountability. Elements: assets, liabilities, revenues, expenses, and net assets. Qualitative characteristics: relevance, reliability, comparability, understandability. Diagram example, conceptual framework in action. Transactions recorded, right pointing arrow 2. Adjustments made, right pointing arrow 3. Financial statements prepared, right pointing arrow 4. Reports issued, right pointing arrow 5. Audits conducted, right pointing arrow 6. Stakeholders informed. 2.6 Accountability and governance. Emphasizes oversight mechanisms such as parliamentary scrutiny, auditing, and public reporting. Strong governance ensures responsible use of public resources and reduces corruption risk. Case study: Country Y introduced IPSAS-based reporting and strengthened its audit office. Result: increased investor confidence in public-private partnership projects and reduced misallocation of funds. 2.7 Challenges in applying standards. Limited technical capacity in government agencies. Resistance to change from cash-based to accrual-based accounting. High implementation costs of modern financial management systems. Political interference in reporting. 2.8 Summary. Public sector accounting is grounded in stewardship, accountability, and performance measurement theories. Key principles include relevance, reliability, comparability, and accountability. International and national standards guide consistent and transparent reporting. Challenges exist, but adoption of proper frameworks strengthens governance and public trust. 2.9 Exercises. Explain stewardship theory and its relevance to public sector accounting. Compare and contrast cash and accrual accounting in the public sector. Identify 3 IPSAS standards and explain their purpose. Discuss how accountability theory influences financial reporting. Give an example from your country where performance measurement has improved public service delivery. Chapter 3: Public Sector Accounting Systems. 3.1 Overview. Public sector accounting systems are frameworks and processes used by government entities to record, classify, and report financial transactions. These systems ensure that resources are used effectively, expenditures are controlled, and revenues are accounted for accurately. A robust accounting system integrates budgetary, financial, and management accounting, enabling transparency, accountability, and informed decision-making. 3.2 Types of accounting systems in the public sector. Cash-based accounting. Transactions are recorded only when cash is received or paid. Simple and easy to implement. Suitable for smaller government units or entities with limited resources. Advantages: easy to understand and maintain. Minimal technical expertise required. Disadvantages: does not reflect liabilities or receivables. Limited usefulness for long-term decision-making. Example: a municipal office records the payment of salaries only when cash is disbursed, ignoring accrued wages owed at month-end. Accrual-based accounting. Transactions are recorded when they are incurred, regardless of cash flow. Provides a complete picture of financial position and performance. Advantages: shows true liabilities and assets. Supports better decision-making and planning. Disadvantages: complex to implement. Requires higher technical capacity and IT systems. Example: a government hospital records the cost of medical supplies when delivered, not when paid for, ensuring accurate reporting of obligations. Fund accounting. Fund accounting is a core feature of public sector accounting. It segregates resources into specific funds, ensuring money is used for intended purposes. Types of funds. General fund, main operating fund for routine government operations. Special Revenue Fund, money restricted for specific programs, e.g., road maintenance or education grants. Capital Projects Fund, funds for large infrastructure projects. Debt Service Fund, resources for debt repayment. Example table, fund accounting in practice. Budgetary accounting. Budgetary accounting focuses on tracking government spending against approved budgets. It is a cornerstone of public sector accountability. Key features. Encumbrances record commitments before expenditure. Actual spending is compared to appropriations. Variances are analyzed to improve planning. Example: if a ministry was allocated $5 million for healthcare but spent $4.5 million, budgetary accounting highlights the $0.5 million variance and reasons for underspending. 3.3 Integrated Financial Management Systems, IFMS. Definition: an IFMS is a computerized system that integrates budgetary, accounting, and reporting functions, enabling real-time tracking of public finances. Core modules: budget preparation and execution, revenue management, expenditure tracking, reporting and audit support. Benefits: improved accuracy and timeliness of reports, reduced risk of errors and fraud, enhanced transparency and accountability, facilitates decision-making for managers and policymakers. Example: Country X implemented IFMS to integrate tax collection, payroll, and procurement. As a result, budget execution reports became available monthly, allowing timely adjustments. 3.4 Chart of Accounts. The chart of accounts is the backbone of any accounting system. It classifies all transactions into categories such as assets, liabilities, revenues, expenses, and fund balances. Example: basic chart of accounts. Assets: cash, receivables, investments. Liabilities: payables, loans, accrued expenses. Revenues: taxes, grants, fees. Expenses: salaries, supplies, infrastructure. Fund balances: equity, general fund balance, restricted fund balance. 3.5 Internal controls in accounting systems. Strong accounting systems require internal controls to safeguard public funds. Key controls: segregation of duties, approval procedures for expenditures, reconciliation of accounts, audit trails and documentation. Example: payments above $10,000 require approval from both the finance officer and department head to reduce the risk of fraud. 3.6 Challenges in public sector accounting systems. Fragmented systems across departments. Limited technical capacity for accrual and IFMS systems. Resistance to change from cash-based methods. Data integrity issues and manual errors. Political interference in reporting and control. 3.7 Case Study: Successful System Implementation. Country Y implemented an IFMS integrating budget, accounting, and procurement modules. Outcomes included: monthly budget performance reports, automated payroll and expenditure tracking, enhanced transparency for public audits, reduced misallocation of funds. 3.8 Summary: public sector accounting systems provide the structure for recording, controlling, and reporting public finances. Key systems include cash-based, accrual-based, fund accounting, and budgetary accounting. Integrated financial management systems enhance efficiency, transparency, and decision-making. Strong internal controls and a well-structured chart of accounts are critical. 3.9 Exercises. Explain the differences between cash-based and accrual-based accounting in the public sector. Describe the types of funds used in fund accounting and their purposes. Discuss the benefits of an integrated financial management system, IFMS. Identify 3 key internal controls necessary in public sector accounting systems. Analyze a case study of your country's accounting system and suggest improvements. Chapter 4: Budgeting in the public sector. 4.1 Overview. Budgeting is a cornerstone of public sector financial management. A budget is a financial plan that outlines anticipated revenues, planned expenditures, and policy priorities for a given period. Unlike private sector budgets, which aim to maximize profit, public sector budgets focus on resource allocation, accountability, and service delivery. Key purposes of public sector budgeting: planning government programs and policies, controlling public expenditure, ensuring efficient and effective resource use, enhancing transparency and accountability. 4.2 Principles of public sector budgeting. Comprehensiveness. All revenues and expenditures should be included in the budget. Unity. A single consolidated budget should be prepared to cover all government activities. Accuracy. Estimates of revenue and expenditure must be realistic. Transparency. Citizens and oversight bodies should understand how funds are allocated. Legality. Budgets must comply with laws and regulations. Flexibility. Budgets should allow adjustments in response to changing circumstances. Example: a Ministry of Health's budget should include salaries, medicines, infrastructure projects, and donor-funded programs, ensuring all expenditures are captured and reported. 4.3 Types of budgets in the public sector. Line item budget. Lists expenditures by category, e.g., salaries, supplies. Simple and easy to understand. Focuses on control of inputs rather than outcomes. Example table: line item budget for Education Department. Program-based budget. Focuses on outputs and outcomes rather than just inputs. Links funding to specific programs and performance objectives. Encourages accountability for results. Example: a health program budget may allocate funds to maternal care, vaccination campaigns, and health education, with measurable targets for each program. Performance budget. Integrates performance indicators into budgeting. Funds are linked to measurable outcomes and efficiency targets. Encourages result-oriented management. Example table: performance budgeting in a transport ministry. Zero-based budgeting, ZBB. Each expenditure must be justified for every budget period. Does not rely on previous budgets. Ensures efficient allocation of resources. Example: a ministry seeking funds for a new IT system must justify the need, cost, and expected benefits rather than relying on last year's allocation. 4.4 Budget preparation process. Planning stage. Ministries and departments identify priorities and resource needs. Policy objectives guide budget estimates. Preparation stage. Departments prepare detailed estimates for revenues and expenditures. Finance Ministry consolidates and reviews proposals. Approval stage. Draft budget is submitted to the legislature, Parliament. Debates, amendments, and approval take place. Implementation stage. Approved funds are released according to budget allocations. Departments execute programs and track spending. Monitoring and evaluation stage. Expenditures are compared to the approved budget. Variances are analyzed and reported. Lessons learned and form the next budget cycle. Diagram: budget cycle. Planning, right pointing arrow 2. Preparation, right pointing arrow 3. Approval, right pointing arrow 4. Execution, right pointing arrow 5. Monitoring and evaluation, right pointing arrow, back to planning. 4.5 Budget execution and control. Appropriation control. Ensures funds are spent only as authorized by the legislature. Commitment control. Tracks obligations before payments are made, encumbrances. Cash flow control. Ensures sufficient liquidity to meet obligations without overspending. Variance analysis. Compares actual expenditures to budgeted amounts. Helps identify overspending or underutilization. Example table, budget variance analysis. 4.6 Challenges in public sector budgeting. Political pressures may distort resource allocation. Inaccurate revenue forecasts can lead to budget deficits. Weak budget execution reduces efficiency. Limited capacity for program-based or performance budgeting. Delayed reporting hinders timely decision-making. Case study, Country X adopted performance-based budgeting for healthcare. Initially, data limitations made it difficult to track outcomes, but gradual improvements in information systems enhanced monitoring and accountability. 4.7 Best Practices in Budgeting. Link budget to policy objectives and strategic plans. Incorporate performance indicators to measure results. Ensure public participation in the budget process. Use technology for budget preparation, monitoring, and reporting. Conduct regular variance analysis and audits. 4.8 Summary. Budgeting in the public sector is a planning, control, and accountability tool. Key types of budgets include line item, program-based, performance, and zero-based budgeting. The budget cycle involves planning, preparation, approval, execution, and evaluation. Effective budget execution requires control mechanisms and variance analysis. Challenges include political pressures, capacity limitations, and weak reporting systems. 4.9 Exercises. Explain the main purposes of public sector budgeting. Compare line item and program-based budgets with examples. Discuss the steps in the budget preparation and approval process. Describe at least 3 methods of budget control in public sector finance. Analyze the challenges faced in implementing performance-based budgeting in your country. Chapter 5, Public Expenditure Management. 5.1 Overview. Public Expenditure Management, PEM, refers to the processes and systems governments use to plan, allocate, control, and evaluate public spending. Effective expenditure management ensures that resources are used efficiently, equitably, and in line with policy objectives, promoting accountability and fiscal discipline. Key objectives of PEM. Ensure funds are spent for intended purposes. Control inefficiency and wastage of public resources. Provide timely and accurate expenditure information. Support fiscal discipline and sustainable public finances. 5.2 Classification of public expenditure. Economic classification. Organizes expenditures according to the type of goods or services purchased. Common categories. Current expenditure, salaries, utilities, supplies. Capital expenditure, infrastructure projects, equipment, land purchases. Transfer payments, grants, social benefits, subsidies. Example table, economic classification. Functional classification. Organizes spending by government function or policy area, e.g., education, health, defense. Helps policymakers analyze priorities and service delivery. Example, the Ministry of Health may allocate funds as 40% for hospitals, 30% for preventive programs, 20% for health administration, 10% for research. Administrative classification. Categorizes expenditures by government department or agency responsible for the funds. Facilitates monitoring at the organizational level. Example table, administrative classification. 5.3 Principles of public expenditure management. Efficiency. Resources should generate maximum output for the least cost. Effectiveness. Spending should achieve intended policy objectives. Equity. Benefits of public expenditure should be distributed fairly. Transparency. All spending should be clear and accountable. Fiscal discipline. Spending should align with available revenues to avoid deficits. 5.4 Public expenditure control. Appropriation control. Ensures funds are spent only as authorized by the legislature. Prevents unauthorized spending and budget overruns. Commitment control. Tracks financial obligations before cash disbursement. Ensures that planned expenditure does not exceed budgeted limits. Cash flow management. Monitors timing of expenditures and revenues to maintain liquidity and solvency. Internal audit. Conducts routine checks on compliance with rules, procedures, and regulations. Detects fraud, inefficiency, and irregularities in spending. 5.5 Monitoring and evaluation of public expenditure. Monitoring. Continuous review of actual expenditure against approved budgets. Highlights variances and facilitates corrective action. Example: if a road maintenance program is allocated $2 million, but only $1.5 million is spent by mid-year, monitoring allows the ministry to investigate delays or reallocate funds. Evaluation. Assesses whether spending achieved intended outcomes. Evaluates cost-effectiveness, efficiency, and social impact. Example table: expenditure evaluation. 5.6 Techniques for expenditure management. Line item monitoring. Checks expenditures against approved line items. Program evaluation. Assesses effectiveness of spending per program. Cost-benefit analysis. Compares costs of programs to their benefits. Performance auditing. Reviews efficiency and results of public spending. 5.7 Challenges in public expenditure management. Political pressures leading to misallocation of funds. Weak financial reporting and lack of timely data. Fragmented accounting systems across agencies. Corruption and misuse of public resources. Capacity constraints in monitoring and evaluation. Case study: Country X introduced program-based budgeting with expenditure monitoring. While efficiency improved in health and education, delays in infrastructure projects persisted due to procurement challenges. 5.8 Best practices in public expenditure management. Integrate budgeting, accounting, and reporting systems. Conduct regular monitoring and audits. Implement program-based and performance-oriented expenditure frameworks. Use technology, IFMS, to track spending and generate real-time reports. Ensure citizen participation and transparency to enhance accountability. 5.9 Summary. Public expenditure management ensures effective, efficient, and accountable use of public resources. Expenditures are classified economically, functionally, and administratively. Control mechanisms, monitoring, and evaluation are critical for fiscal discipline. Challenges exist, but technology, integrated systems, and transparency improve expenditure management. 5.10 Exercises. Explain the three main classifications of public expenditure. Describe at least 4 principles of effective expenditure management. Discuss how monitoring and evaluation improve accountability in public spending. Identify challenges faced in expenditure management in your country. Analyze a case where expenditure mismanagement affected service delivery. Chapter 6. Revenue generation in the public sector. 6.1 Overview. Revenue generation is a critical component of public finance, as it provides the resources for governments to deliver services, implement policies, and invest in infrastructure. Public sector revenue comes from a mix of taxes, non-tax sources, grants, and borrowing, and its management is key to fiscal sustainability. Key objectives: ensure sufficient resources for government programs, promote equity in taxation and resource distribution, provide a stable and predictable revenue base, support macroeconomic stability. 6.2 Sources of public revenue. Tax revenue. Taxes are compulsory payments levied by governments to finance public services. They are the primary source of revenue for most governments. Types of taxes. Direct taxes, levied on income, profits, and property. Examples: income tax, corporate tax, property tax. Characteristics: progressive, higher income right pointing arrow higher tax. Indirect taxes, levied on goods and services, collected at the point of sale. Examples: value-added tax, VAT, sales tax, excise duties. Characteristics: can be regressive, collected by businesses on behalf of government. Example table: tax revenue sources. Non-tax revenue. Non-tax revenue includes funds collected by the government other than taxes. Sources: fees and charges, licenses, permits, utility charges. Fines and penalties, traffic fines, environmental penalties. Dividends from state-owned enterprises. Interest on loans and investments. Example: a government collects fees from business registration, issues vehicle licenses, and earns dividends from a state-owned bank. Grants and aid. Grants are funds provided by higher levels of government or international organizations. They can be conditional grants, funds for specific programs with reporting requirements. Unconditional grants, funds with no specific restrictions, can be used freely. Example: World Bank grants for rural infrastructure projects. Central government grants to local municipalities for general operations. Borrowing. Governments may also raise funds through domestic or external borrowing, though this is classified as financing rather than revenue. Domestic borrowing, treasury bonds, loans from banks. External borrowing, loans from international agencies or foreign governments. Caution: excessive borrowing can increase debt burden and interest obligations. 6.3 Principles of Revenue Generation. Equity. Taxation should be fair and based on the taxpayer's ability to pay. Efficiency. Revenue collection should minimize administrative costs and economic distortions. Simplicity. Tax laws and payment procedures should be easy to understand and enforce. Transparency. Revenue policies and collection mechanisms should be open to public scrutiny. Predictability. Revenue streams should be stable to facilitate budget planning. Example: a progressive income tax ensures that high-income earners contribute more, while VAT is simple to administer but may be regressive if not carefully designed. 6.4 Revenue forecasting. Revenue forecasting involves estimating expected income from various sources for budget planning. Accurate forecasts are critical to avoid deficits or surpluses. Methods of forecasting. Trend analysis uses historical data to project future revenues. Economic modeling uses macroeconomic indicators such as GDP, inflation, and employment. Expert judgment, adjustments based on policy changes or special circumstances. Example table: revenue forecast. 6.5 Tax administration and compliance. Tax administration. Collection, enforcement, and auditing of taxes. Agencies, revenue authorities, tax offices, customs. Compliance measures. Taxpayer education. Incentives for timely payment. Penalties for evasion or late filing. Example: Country X introduced an online tax filing system, increasing compliance rates from 70% to 90% within 3 years. 6.6 Challenges in revenue generation. Tax evasion and avoidance reduce collections. Weak administrative capacity affects compliance and monitoring. Dependence on volatile revenue sources like trade taxes or oil exports. Political interference can distort tax policies. Inequitable tax systems may burden the poor disproportionately. Case study: a developing country struggled with low VAT compliance, losing 15% of potential revenue. After reforming tax administration and introducing automated systems, collections improved significantly. 6.7 Best practices in revenue generation. Diversify revenue sources to reduce dependency on a single stream. Strengthen tax administration and enforcement. Use technology for collection, monitoring, and reporting. Promote fairness and equity in taxation. Conduct regular audits and transparency reporting. 6.8 Summary. Public revenue comes from taxes, non-tax sources, grants, and borrowing. Taxes can be direct or indirect, while non-tax revenue includes fees, fines, and dividends. Accurate revenue forecasting is critical for budget planning and fiscal sustainability. Strong administration, compliance mechanisms, and equitable policies enhance revenue generation. 6.9 Exercises. Identify and explain the main sources of public revenue in your country. Compare direct and indirect taxes, giving examples. Discuss the principles of effective revenue generation. Explain the methods used for revenue forecasting. Analyze the challenges of revenue generation and suggest strategies to improve collections. Chapter 7. Public Debt Management. 7.1 Overview. Public debt management involves planning, borrowing, and repaying government debt to finance budget deficits, investment projects, or other public expenditures. Effective debt management ensures that borrowing costs are minimized, risks are controlled, and fiscal sustainability is maintained. Objectives of public debt management. Ensure funds are available for government programs. Minimize borrowing costs over the medium and long term. Manage risk associated with debt repayment. Maintain a sustainable debt-to-GDP ratio. 7.2 Types of public debt. Domestic debt. Borrowed from local sources such as banks, pension funds, or the public. Can be in the form of bonds, treasury bills, or loans. Advantages. Easier to control and monitor. Reduces dependence on foreign lenders. Disadvantages. Can crowd out private sector borrowing. High domestic interest rates may increase cost. Example: a government issues 5-year treasury bonds to fund a road construction project. External debt. Borrowed from foreign governments, international financial institutions, IMF, World Bank, or private lenders. Advantages. Provides access to large amounts of capital. May offer concessional loans at lower interest rates. Disadvantages. Subject to currency risk and exchange rate fluctuations. Political and economic conditions abroad can affect repayment. Example: country X borrows $100 million from the World Bank to finance a water infrastructure project. 7.3 Debt sustainability. Debt sustainability refers to a government's ability to service debt obligations without compromising fiscal stability or growth. Indicators of debt sustainability. Debt to GDP ratio measures total debt relative to national income. Debt service ratio measures the portion of revenue used to repay interest and principal. Fiscal deficit. Persistent deficits may indicate rising debt risks. Example table: Debt sustainability analysis. 7.4 Debt management strategies. Domestic debt management. Stagger maturities to avoid refinancing risk. Diversify sources, bonds, bills, and loans. Monitor interest rate trends to reduce costs. External debt management. Favor concessional and long-term loans. Hedge against currency and interest rate risk. Maintain transparent reporting to lenders and stakeholders. Debt restructuring. Negotiating new terms for repayment if obligations cannot be met. Can involve extension of maturities, reduction of interest rates, or partial forgiveness. Example: a country renegotiates its external loans with creditors to extend repayment by 5 years, reducing immediate fiscal pressure. 7.5 Public-private partnerships (PPPs). PPPs involve collaboration between government and private sector to finance, build, and operate public projects. Advantages. Reduces immediate fiscal pressure on government. Leverages private sector expertise and efficiency. Can accelerate infrastructure development. Challenges. Long-term contingent liabilities for government. Complex contracts and legal issues. Need for effective monitoring and performance evaluation. Example: a private company finances and operates a toll road under a 20-year PPP contract, while the government monitors service quality and toll rates. 7.6 Debt reporting and transparency. Accurate reporting is crucial for accountability and fiscal discipline. Reports should include total debt stock, domestic and external, debt service obligations, maturity profiles and interest rates, contingent liabilities, e.g. PPPs. Example table: Public Debt Report. 7.7 Challenges in public debt management. High reliance on volatile external borrowing. Weak capacity to forecast debt obligations accurately. Currency and interest rate risks. Political pressures leading to overborrowing. Poor monitoring of contingent liabilities, like PPPs. Case study: country-wise debt-to-GDP ratio rose above 80% due to over-reliance on short-term external borrowing. By restructuring loans and improving domestic debt management, it reduced refinancing risks and stabilized fiscal health. 7.8 Best practices in public debt management. Develop a comprehensive debt strategy aligned with fiscal policy. Diversify borrowing sources and instruments. Prioritize long-term concessional debt to reduce cost. Maintain transparent reporting and parliamentary oversight. Monitor and manage contingent liabilities from PPPs and guarantees. 7.9 Summary. Public debt management ensures governments can meet obligations while maintaining fiscal stability. Debt types include domestic and external, each with advantages and risks. Sustainability indicators, such as debt-to-GDP and debt service ratios, guide fiscal policy. Debt management strategies include proper planning, risk management, and reporting. PPPs offer an alternative financing mechanism, but require careful oversight. 7.10 Exercises. Explain the differences between domestic and external debt. Discuss the indicators used to assess debt sustainability. Analyze the advantages and challenges of public-private partnerships. Describe strategies to reduce the risk of excessive public debt. Prepare a sample debt report for a government entity, including domestic debt, external loans, and PPP obligations. Chapter 8. Auditing in the Public Sector. 8.1 Overview. Auditing in the public sector is essential to ensure accountability, transparency, and proper use of public resources. Audits provide assurance that government funds are managed in compliance with laws, regulations, and approved budgets. Objectives of public sector auditing. Verify the accuracy and completeness of financial statements. Assess compliance with laws, policies, and regulations. Evaluate the economy, efficiency, and effectiveness of public spending. Strengthen public trust and accountability. 8.2 Types of auditing. Internal audit. Conducted by staff within government agencies. Provides continuous review and monitoring of operations and finances. Focuses on risk management, internal controls, and operational efficiency. Key functions. Assess compliance with internal policies and procedures. Review budget execution and expenditure control. Identify inefficiencies and recommend improvements. Example: an internal audit of a municipal procurement office might examine whether purchasing procedures were followed and if goods were received according to specifications. External audit. Conducted by independent bodies such as the Auditor General or Supreme Audit Institutions, say. Ensures accountability to Parliament and citizens. Evaluates financial statements, compliance, and performance. Key functions. Express opinion on the fairness of financial statements. Assess legal compliance of government operations. Evaluate effectiveness of programs and projects. Example: the Auditor General audits a national health program to verify that funds were used according to the approved budget and reports findings to Parliament. Performance audit focuses on the economy, efficiency, and effectiveness, 3 E's, of programs and projects. Goes beyond financial compliance to assess outcomes. Example: a performance audit of a school feeding program might evaluate whether the allocated budget improves student attendance and nutrition levels. 8.3 Audit process in the public sector. Planning. Identify objective, scope, and key risks. Develop audit program and allocate resources. Fieldwork. Collect evidence through inspections, interviews, and testing. Review financial records, transactions, and internal controls. Reporting. Prepare audit report summarizing findings, conclusions, and recommendations. Report submitted to management, legislature, and public stakeholders. Follow-up. Monitor implementation of recommendations. Evaluate effectiveness of corrective actions. Diagram. Audit cycle, planning, right pointing arrow, fieldwork, right pointing arrow, reporting, right pointing arrow, follow-up, right pointing arrow, back to planning. 8.4 Key audit principles. Independence. Auditors must be free from influence by auditees. Objectivity. Audit findings should be unbiased and based on evidence. Integrity. Auditors must adhere to ethical standards. Competence. Auditors must have relevant knowledge and skills. Transparency. Audit results should be communicated clearly and publicly where appropriate. 8.5 Roles and responsibilities. 8.6 Challenges in public sector auditing. Limited technical capacity and skilled auditors. Political interference, affecting independence. Inadequate access to reliable data and records. Weak follow-up on audit recommendations. Complexity of auditing performance-based and PPP projects. Case study: in Country X, weak internal audit functions and political interference delayed audit reports. After strengthening the Auditor General's independence and introducing technology for auditing, compliance improved significantly. 8.7 Best practices in public sector auditing. Strengthen auditor independence and governance frameworks. Implement risk-based auditing, focusing on high-risk areas. Use technology and data analytics to improve efficiency and coverage. Ensure timely reporting and follow-up of audit recommendations. Promote public access to audit findings to enhance transparency. 8.8 Summary. Auditing ensures accountability, transparency, and proper use of public funds. Types of audits include internal, external, and performance audits. Effective auditing relies on planning, fieldwork, reporting, and follow-up. Challenges such as political interference, weak capacity, and poor follow-up can undermine audit effectiveness. Best practices include independence, risk-based auditing, and technology adoption. 8.9 Exercises. Explain the difference between internal and external audits in the public sector. Discuss the objectives of a performance audit. Describe the key steps in the public sector audit process. Identify challenges that affect the effectiveness of auditing in government agencies. Analyze a case where audit recommendations improved accountability in public spending. Chapter 9. Financial Reporting and Accountability. 9.1 Overview. Financial reporting in the public sector is the process of preparing and presenting financial information to inform stakeholders about the use of public resources. Accurate reporting ensures accountability, transparency, and sound decision-making by government agencies. Objectives of public sector financial reporting. Provide information on financial position and performance. Ensure compliance with laws, regulations, and approved budgets. Support decision-making by policymakers and citizens. Enhance public confidence and trust in government operations. 9.2 Users of public sector financial reports. 9.3 Key financial statements in the public sector. Statement of financial position. Shows assets, liabilities, and net assets at a point in time. Helps assess the government's financial health and solvency. Example table. Statement of financial performance, income statement. Reports revenues, expenses, and surplus deficit over a period. Indicates whether resources were used efficiently. Example table. Surplus deficit 3 million. Cash flow statement. Tracks cash inflows and outflows during a period. Ensures liquidity and proper cash management. Example table. Net cash change 1 million. Statement of changes in net assets. Shows how net assets have changed due to transactions and adjustments. Enhances transparency about the accumulation and use of public resources. 9.4 Reporting Standards and Compliance. IPSAS, International Public Sector Accounting Standards. Provides guidance on accrual-based reporting for public sector entities. Enhances comparability, transparency, and accountability. National Accounting Standards. Many countries adopt or adapt IPSAS to local legal and fiscal contexts. Standards often cover fund accounting, cash flow reporting, and performance reporting. Example, the UK follows the Government Financial Reporting Manual, FREM, which aligns with IPSAS principles but includes national legal requirements. 9.5 Accountability through financial reporting. Budgetary accountability, comparing actual spending with approved budgets. Fiscal accountability, reporting on revenue collection, debt obligations, and fiscal sustainability. Performance accountability, linking expenditures to outcomes and program effectiveness. Transparency, public access to financial reports allows citizen scrutiny and participation. Example, a ministry publishes its annual financial report showing spending on healthcare, highlighting achievements in reducing maternal mortality and vaccine coverage. 9.6 Challenges in financial reporting. Limited capacity in accrual accounting and reporting. Fragmented systems leading to inconsistent or delayed reports. Political interference affecting the objectivity of reports. Weak internal controls reducing reliability. Difficulty linking financial information to performance outcomes. Case study, Country X transition from cash-based to accrual-based reporting. Initially, discrepancies between departments delayed reporting, but training and system integration improved accuracy and timeliness. 9.7 Best Practices in Public Sector Financial Reporting. Adopt international or national reporting standards consistently. Integrate accounting systems to generate real-time, accurate reports. Link financial reporting to performance outcomes. Ensure independent auditing and timely publication. Promote citizen-friendly reporting formats for transparency. 9.8 Summary. Public sector financial reporting ensures accountability, transparency, and fiscal discipline. Key statements include the Statement of Financial Position, Statement of Financial Performance, Cash Flow Statement, and Statement of Changes in Net Assets. Compliance with IPSAS or national standards improves comparability and reliability. Reporting enhances accountability by linking financial management to budgets, performance, and public scrutiny. 9.9 Exercises. List the key users of public sector financial reports and their information needs. Compare the Statement of Financial Performance and Cash Flow Statement in terms of purpose and content. Explain how financial reporting enhances budgetary and performance accountability. Identify challenges in implementing accrual-based reporting in government agencies. Prepare a simple Statement of Financial Position and Statement of Financial Performance for a hypothetical government ministry. Chapter 10. Public Sector Financial Management Reforms. 10.1 Overview. Public Sector Financial Management, PFM, reforms aim to modernize government accounting, budgeting, and reporting systems to improve efficiency, transparency, and accountability. Reforms are driven by the need to strengthen fiscal discipline, optimize resource allocation, and meet public expectations for quality services. Objectives of PFM reforms: enhance efficiency and effectiveness of public spending, promote accountability and transparency in the use of public funds, integrate budgeting, accounting, and reporting for better decision-making, support policy and strategic objectives of government. 10.2 Drivers of financial management reforms. Globalization and economic pressures. Governments face pressure to adopt international accounting and reporting standards. Technological advancements. Digital tools allow automation, integration, and real-time monitoring of public finances. Demand for transparency. Citizens and stakeholders expect accessible, reliable, and timely financial information. Efficiency and performance goals. Shift from input-based to output and outcome-based management. Fiscal challenges. Reforms help governments manage deficits, debt, and revenue volatility effectively. 10.3 Key areas of PFM reforms. Budget reforms. Introduction of program-based and performance budgets to link spending to results. Adoption of medium-term expenditure frameworks, MTEF, to improve planning and predictability. Strengthen budgetary controls and monitoring. Example: a Ministry of Health uses program-based budgeting to allocate funds based on vaccination targets, linking budget allocations to measurable outcomes. Accounting and reporting reforms. Shift from cash-based to accrual-based accounting for better financial transparency. Adoption of IPSAS or national standards to standardize reporting. Integration of financial data across departments to support real-time reporting. Example: Country X implemented an accrual accounting system that allows consolidated financial statements for all ministries, improving reliability and comparability. Internal control and audit reforms. Strengthening internal audit functions to ensure compliance and operational efficiency. Implementation of risk-based auditing to focus on high-risk areas. Enhanced follow-up mechanisms for audit recommendations. Example: an internal audit unit monitors procurement activities across ministries and reports quarterly to ensure adherence to procurement rules. Public Financial Management Systems, PFMS. Integrated Financial Management Systems, IFMS, automate accounting, budgeting, and reporting. Provides real-time monitoring of expenditures, revenues, and cash flows. Reduces manual errors, delays, and corruption risks. Example: an IFMS enables automated payroll processing, expenditure approvals, and real-time budget tracking across all government departments. Transparency and accountability reforms. Adoption of open budget initiatives for citizen participation. Publishing annual financial reports, audit findings, and budget performance reports online. Encouraging public oversight through participatory mechanisms. Example: Countrywide publishes its national budget and mid-year expenditure reports online, allowing citizens to track government spending. 10.4 Challenges in implementing reforms. Resistance to change. Staff and political actors may resist new systems. Capacity constraints. Limited skills and technical expertise hinder adoption. High costs. Implementing integrated systems and training personnel requires significant investment. Fragmented systems. Existing systems may not easily integrate with new platforms. Weak governance. Lack of oversight can undermine reform effectiveness. Case study: Country X faced delays in implementing an IFMS due to resistance from ministries and insufficient IT infrastructure. Through targeted training and phased implementation, the system became fully operational within 3 years. 10.5 Best practices in PFM reforms. Adopt a phased implementation approach. Start with high-priority areas before full-scale rollout. Invest in capacity building. Train staff on new systems and processes. Use technology effectively. Implement integrated systems and data analytics. Ensure strong governance. Establish clear accountability, oversight, and monitoring mechanisms. Promote transparency and participation. Engage citizens, media, and civil society in financial oversight. 10.6 Emerging Trends in Financial Management Reforms. Digital government, e-procurement, e-payments, and online reporting improve efficiency. Performance-based management, greater focus on linking expenditure to outcomes and social impact. Public-private partnerships, efficient delivery of public services through collaboration with private sector. Data-driven decision-making, using analytics and dashboards for monitoring performance and risks. Sustainable financing, emphasis on long-term debt sustainability and responsible fiscal policy. 10.7 Summary. PFM reforms aim to modernize government financial management for better efficiency, transparency, and accountability. Key reform areas include budgeting, accounting, reporting, internal controls, and financial systems. Implementation challenges such as resistance, capacity gaps, and cost can be mitigated with phased approaches, training, and governance improvements. Best practices and emerging trends emphasize technology, performance orientation, citizen engagement, and sustainability. 10.8 Exercises. Explain the main objectives of public sector financial management reforms. Discuss how technology, such as IFMS, contributes to better financial management. Identify challenges governments face in implementing PFM reforms. Analyze the role of transparency and citizen participation in financial management reforms. Give an example of a successful PFM reform in your country and its impact on accountability and efficiency. Chapter 11. Ethics and Governance in Public Sector Accounting. 11.1 Overview. Ethics and governance are central to public sector accounting because government accountants manage resources entrusted by the public. Ethical behavior ensures that funds are used legally, efficiently, and transparently, fostering trust, accountability, and good governance. Objectives of ethics and governance in public sector accounting. Promote integrity and professionalism among accountants. Prevent fraud, corruption, and misuse of public funds. Enhance accountability and transparency in financial management. Strengthen public confidence in government institutions. 11.2 Principles of Ethics in Public Sector Accounting. Integrity. Act honestly, avoid conflicts of interest, and uphold public trust. Objectivity. Make decisions and report financial information without bias. Professional competence. Maintain and update knowledge and skills in accounting and financial management. Confidentiality. Protect sensitive financial and organizational information. Accountability. Take responsibility for financial decisions and actions. Transparency. Ensure that information and decisions are clear, accurate, and accessible to stakeholders. Example: a government accountant ensures all procurement expenditures are recorded accurately and avoids favoritism in reporting or approvals. 11.3 Governance in Public Sector Accounting. Governance refers to the framework of rules, practices, and processes by which public sector organizations are directed and controlled. Strong governance ensures efficient use of resources, compliance with laws and regulations, risk management, oversight, and accountability. Key governance structures. Legislative oversight. Parliament reviews budgets, expenditures, and audit reports. Internal controls. Procedures and checks within departments to prevent misuse of funds. External audits. Independent evaluation of compliance, performance, and financial accuracy. Anti-corruption agencies. Institutions responsible for detecting and preventing financial misconduct. 11.4 Common ethical challenges in public sector accounting. Fraud and embezzlement, misappropriation of public funds. Conflict of interest, favoring personal or political interests over public interest. Bribery and corruption, accepting or offering inducements to influence financial decisions. Misreporting, manipulating financial data for political or personal gain. Weak enforcement, inadequate consequences for unethical behavior. Case study: a local government official diverted funds meant for school infrastructure to personal accounts. Weak internal controls delayed detection, emphasizing the need for strong governance and ethical standards. 11.5 Strategies to promote ethics and good governance. Ethical codes and guidelines. Establish codes of conduct for accountants and finance officers. Provide guidance on conflict of interest, reporting, and decision-making. Training and capacity building. Regular training in ethics, anti-corruption, and professional standards. Foster a culture of accountability and integrity. Strong internal controls. Segregation of duties in financial transactions. Approval hierarchies and authorization limits. Reconciliation and verification of financial records. Independent oversight and auditing. Empower Auditor General and internal audit units. Ensure timely reporting and follow up on audit recommendations. Whistleblower protection. Protect individuals who report unethical practices. Encourage transparency and early detection of misconduct. Example: Country X implemented a whistleblower hotline for public finance irregularities, which led to a 30% increase in reported cases and faster corrective action. 11.6 The role of technology in promoting ethics. Digital financial management systems reduce opportunities for manipulation. E-procurement platforms enhance transparency in tendering processes. Automated reporting and audit trails improve accountability and reduce errors. Example: an integrated financial management system, IFMS, ensures that all payments are traceable, reducing the risk of fraud in government procurement. 11.7 Best practices in ethics and governance. Develop and enforce comprehensive codes of conduct. Establish independent audit and oversight bodies. Promote transparent financial reporting, accessible to citizens. Invest in continuous training and professional development. Encourage ethical leadership and a culture of integrity. Use technology to strengthen controls and transparency. 11.8 Summary. Ethics and governance are fundamental to trustworthy public sector accounting. Principles such as integrity, objectivity, accountability, and transparency guide ethical behavior. Governance mechanisms, including internal controls, audits, and legislative oversight, ensure responsible use of public funds. Challenges such as corruption, conflict of interest, and weak enforcement require training, codes of conduct, oversight, and technology. Strong ethical practices and governance frameworks enhance public confidence and fiscal discipline. 11.9 Exercises. Explain why ethics is critical in public sector accounting. Identify at least 5 common ethical challenges faced by public accountants. Discuss the role of internal controls in promoting ethical financial management. Analyze the impact of whistleblower protection on public accountability. Give examples of how technology can enhance ethics and governance in public finance. Chapter 12. Emerging Trends and Innovations in Public Sector Accounting and Finance. 12.1 Overview. Public sector accounting and finance are evolving rapidly due to technological advances, globalization, and increasing demands for transparency and sustainability. Governments are adopting innovative practices to enhance efficiency, accountability, and service delivery. Key objectives of embracing trends and innovations: improve financial management and reporting accuracy, promote transparency, accountability, and citizen engagement, enhance efficiency and cost-effectiveness in resource allocation, align public sector finance with Sustainable Development Goals, SDGs. 12.2 Technological innovations in public sector finance. Integrated Financial Management Systems, IFMS, automates budgeting, accounting, reporting, and cash management. Enables real-time monitoring of expenditures and revenues. Reduces manual errors and enhances fiscal discipline. Example: Country X's IFMS tracks all government payments electronically, reducing delays and improving transparency. E-procurement systems, digital platforms for tendering, bidding, and contract management. Increases competition, reduces corruption, and ensures transparency. Example: an e-procurement portal allows suppliers to submit bids online, automatically recording all transactions for audit purposes. Data analytics and big data. Uses large datasets to predict revenue trends, monitor expenditures, and detect anomalies. Supports evidence-based policymaking and risk management. Example: a tax authority uses analytics to identify patterns of tax evasion and target high-risk sectors for audits. Blockchain in public finance. Provides immutable, transparent records of transactions. Enhances trust, reduces fraud, and improves auditing efficiency. Example: blockchain can track social welfare payments, ensuring that funds reach intended beneficiaries without intermediaries siphoning resources. 12.3 Sustainability and Green Public Finance. Green budgeting. Allocates public funds to environmentally sustainable projects. Integrates climate change and sustainability goals into financial planning. Example: funding renewable energy projects, sustainable transportation, and energy-efficient public buildings. Sustainable public investments. Prioritizes projects that promote long-term social, environmental, and economic benefits. Incorporates impact assessments and cost-benefit analyses in decision-making. Performance and outcome-based innovations. Program-based budgeting (PBB) focuses on outputs and outcomes rather than inputs. Performance dashboards provide real-time indicators of program efficiency and effectiveness. Citizen-centric reporting. Simplified financial reports for public understanding and engagement. Example: a dashboard shows progress on healthcare, education, and infrastructure programs, linking spending to results. 12.5 Public-private partnerships (PPPs) and alternative financing. PPPs leverage private sector resources for public service delivery. Innovations in financing include social impact bonds, green bonds, and blended finance. Encourages efficiency, innovation, and risk sharing. Example: issuing a green bond to fund urban public transport projects reduces congestion and carbon emissions while involving private investors. 12.6 Challenges in adopting innovations. High implementation costs for new systems and technologies. Resistance to change among staff and stakeholders. Cybersecurity risks and data privacy concerns. Capacity constraints and need for training. Integration issues with existing legacy systems. Case study: Country Y implemented an IFMS and e-procurement system, improving transparency, but faced challenges in staff adaptation and cybersecurity, which were addressed through training and robust IT policies. 12.7 Best practices for embracing innovation. Conduct cost-benefit analysis before adopting new systems. Provide training and capacity-building programs for staff. Ensure integration with existing financial management systems. Implement robust cybersecurity and data protection measures. Promote transparency, citizen engagement, and sustainability in financial decision-making. 12.8 Future directions in public sector accounting and finance. Artificial intelligence, AI, and machine learning automate audits, predict fiscal risks, and improve revenue forecasting. Cloud-based financial systems enhance accessibility, scalability, and data sharing across departments. Sustainable finance integration align budgets with SDGs and climate targets. Open data and citizen engagement expand public access to financial information, to enhance accountability. Enhanced risk management. Use predictive analytics to anticipate fiscal challenges and mitigate financial risks. 12.9 Summary. Emerging trends in public sector accounting include digital financial management, performance-based budgeting, sustainability, and PPPs. Technology innovations such as IFMS, e-procurement, blockchain, and data analytics improve efficiency, transparency, and accountability. Sustainability-oriented financial management ensures alignment with environmental and social goals. Challenges include cost, capacity, resistance, and cybersecurity risks, which can be mitigated through training, planning, and robust governance. Future trends emphasize AI, cloud computing, open data, and sustainable financing, shaping the next generation of public financial management. 12.10 Exercises. Explain how digital innovations, such as IFMS and e-procurement, improve public financial management. Discuss the role of green budgeting in promoting sustainable public finance. Identify challenges governments face when implementing emerging technologies in finance. Provide examples of how PPPs and innovative financing mechanisms improve service delivery. Analyze how AI and data analytics could transform auditing and revenue forecasting in the public sector. Epilogue. Public sector accounting and finance form the backbone of effective governance. Throughout this book, we have journeyed from the foundations of public finance, budgeting and expenditure management, through revenue generation, debt management, auditing, and financial reporting, to emerging trends and innovations that are reshaping government financial management. The lessons learned are clear. Transparency, accountability, and ethical stewardship of public resources are not optional. They are essential for the trust and confidence of citizens, investors, and international partners. Governments that integrate modern technology, performance-oriented budgeting, and sustainable practices position themselves to deliver efficient, equitable, and impactful public services. Yet challenges remain. Resistance to change, capacity constraints, and corruption continue to test the effectiveness of public financial management. It is in this context that continuous reform, professional development, and ethical leadership become critical. Public sector accountants and financial managers are more than record keepers. They are stewards of public trust and catalysts for sustainable development. As the field evolves, the integration of digital solutions, data analytics, AI, and sustainability-oriented finance promises unprecedented opportunities for governments to optimize resources, enhance decision-making, and respond to the dynamic needs of society. Ultimately, this book is not merely a manual, it is a call to action. It encourages practitioners, policymakers, auditors, and students alike to embrace the principles, practices, and innovations that define modern public sector accounting and finance. By doing so, we ensure that public resources are managed with integrity, efficiency, and foresight, securing a foundation for good governance and societal progress for generations to come. Sound public finance is not just a technical requirement. It is the engine of trust, equity, and sustainable development.